Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab. And this is Getting Started with Options. And today, we're going to be putting on a bullish put spread, but planning the exits in advance. We want to talk about managing the profits and the losses of credit spreads through the placement of planned orders. So we're going to be going from start to finish on the trade. Should be a really interesting discussion. As complete as I can make it, but before we can get to any of that, let me first of all say hello to everybody who's already chatting out on YouTube. Hello, great to see so many familiar names again. Hello there, Chuck and Will, Eva, Richard, Lawrence, Kevin, Brown Buffalo, Joe, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the show has been concluded and you're just checking out the recording, enjoy that presentation. But be aware that you're invited to join us in the live discussion. This is a Tuesday webcast series. We kick things off promptly at noon Eastern Standard Time. Would love to have you here in the live stream audience. Also, as a special treat for our live stream audience attendees, we have Connie Hill hanging out in the chats with me. Connie's going to be addressing any questions that I can't get to during the flow of the presentation. Connie, thanks for having my back. And Connie and I would like to issue an invitation to everybody watching. If you have an account on X, give us a follow. You should be following your favorite presenters there. It's the best place to connect with your favorite presenters. In between these live streams, you can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. But let's get into this discussion of managing credit spread profits and losses using planned trade or exit orders. And of course, the first thing that we need to do is this is an undertaking that involves risks, so we need to bear these important disclosures in mind. The information here is for general informational purposes only, should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Options carry a high level of risk and are not suitable for all investors. And investing involves risks, including the loss of principal. Finally, any investment decision you make in your self-directed account is solely your responsibility. So here's how we're going to proceed with this discussion. The first thing I'm going to do is take a quick look at the S&P 500. It's been a nice run since we had that drop into bear market territory. There's been a rally of about 22% on the S&P 500. And so we're going to look at that. We're going to put ourselves in the shoes of a bullish trader and construct a bullish credit spread for today's discussion. Then we're going to plan the management of the exits on either side, managing an exit if the trade is working, and managing and place, or let's say planning and placing an exit for the trade in the event that it doesn't work out. So let's go right to the S&P 500 and get that context. Okay. Oh, Eva says, about X, you'd love to know which cities you were in while visiting Scotland to go along with all the castles. Maybe I'll have to make up a list. It's a lot. I get around in Scotland. Anyway, so here's S&P 500. Here's the S&P 500. Here's that sell-off that started right there, February 19th. Ugly history for the bulls. Lower highs and lower lows, hitting that ultimate. Now we can see with the benefit of hindsight that low on April 7th, but since then, a sharp rebound. And just in this it's really only been about 5 weeks, maybe 6 weeks, we've come back up about 22%. We haven't gotten back to those all-time highs, but maybe the markets are working their way there. Obviously, time will tell. We'll see if we get there. But let's put ourselves in the shoes of a would-be options trader. And maybe they're looking at how the markets are behaving, and they want to try to benefit from hopefully a continued bullish move on the markets. And so we're going to plan a trade for out here in June. The June 20th expiration is going to be our trade example for today. And we're going to be planning a bullish put spread, a credit spread. That's going to be the focus of today's discussion. We're going to be talking about specifically the bullish side of things, but even our bearish traders out there when trading credit spreads can employ a similar approach to what we'll be discussing today. But let's just say that our trader has the conviction that here we are right now, and they think we're likely to go up at least somewhat higher. maybe dramatically higher, maybe a little bit higher, but maybe in their view, the bulk of the technical evidence points towards higher prices on the S&P, and hopefully by extrapolation, a lot of these S&P component companies, one of which, let's switch over to our example stock for today, is JP Morgan Chase. So before we get into the technical setup for this discussion, what are some considerations? I try to go at a pace that everybody can follow, and I'm sure everybody says, well, you just skipped a big important thing, Cameron. You went from the markets to an individual stock. How did you find this stock? Well, this is an S&P 500 component company. A potential benefit of that for some traders is, number one, liquidity. Yeah, illiquid stocks tend to have illiquid options. It can be difficult to trade those profitably as the spreads between the bid price and the ask price widen. It's just not, well, it can be difficult, all right? Now, even with great liquidity, it doesn't mean that trading options for profit is simple. Nope. But wherever a trader can smooth that road, maybe they want to do that as much as possible. So liquidity is a concern, and this is one of the biggest, most liquid stocks really in the world. Now, another consideration is the price per share. When we're trading options, we're taking on potential obligations, and we are going to include in this discussion an obligation to maybe have to buy 100 shares, 200 shares, 300 shares of JP Morgan Chase, depending on how many contracts we ultimately trade. But higher priced stocks carry larger and larger and larger per share obligations. Now, we're going to be attempting to minimize that by including a long option, but there's still a risk. We have to talk through that. Anyway, but yeah, price per share can be a consideration. Liquidity can be a consideration. There are other things like maybe avoiding earnings if a trader has those sorts of preferences. All kinds of other potential pre-qualifiers for selecting a stock for trading. But primarily, I was looking at price per share. I was looking at liquidity, and also what's going on with the chart. Lisa says, can you show how to put an OCO stop order on a sold option, a profit stop and loss stop? If not, can you direct me where to get this info? Lisa, we're going to be doing that on today's trade. It can also be done on an existing trade. I don't know, if time permits, maybe I can do both. We'll see. All right. But let's look at what's been going on technically, just looking at the chart. And here's what a trader might note. There's been a sharp recovery from that same low that the S&P had. A lot of the finance stocks have sort of taken their marching orders from the broader market conditions. But you can see that JP Morgan has been making higher highs and higher lows. It came up here. There was a little hesitation over a course of about a week at about that $255 level. And you can see why, for some traders, there may have been some hesitation. Sometimes a trader will look back to the past at current prices, compare those prices to how they behaved at similar levels historically. And maybe for some, they might have noted, boy, the last time we were at 255 bucks, this was kind of the worst time to get into a bullish trade, because within a couple of weeks, our stock was down, what? Looks like about 25%. And before that, we had previously visited 255 and sold off all the way down to 230. So that was not as dramatic, but maybe a 10% retracement in price. Now, there have been times when we were able to break up and above that 255. So there was one successful event where we got up above and stayed above. So this might be an important price ceiling. And interestingly, after we hesitated at those 255 levels, gapped up on some overnight enthusiasm, and price this may be a scenario. This is the way that a technician might view this, is when we can clear a significant hurdle like that, that may set the stock off and running. Now, it's not a guarantee that it's going to, but let's just say that that's our trader's conviction. So they see apparent bullishness on the S&P, they see apparent bullishness on the chart. Well, let's go place a bullish trade. So let's structure an example trade here. Now, bear in mind, let's keep this level in mind, the 255 level, because what a trader might suspect from here is if they're wrong about the timing, maybe at the very least, if price comes down, it could find a new price floor at that previous price ceiling. So old resistance becoming new support. So let's structure our trade to benefit just as long as the stock is able to stay above that 255 level, and specifically to be above that level by June 20th. So let's go to our trade tab. Let's go out here to the June contracts, the 20th of June. I'm staying with the monthly expiration rather than one of the weeklies, again, for liquidity concerns. I sometimes get asked, Cameron, why does it seem that you don't demonstrate the weeklies very often? Sometimes I do, but the monthly contracts just have stronger liquidity on average than the weeklies. So that's it. You'll tend to see narrower spreads between the bid price and the ask price, getting in and getting out, maybe a little bit smoother. But let's look at our 255 put, and here's going to be our example trade for the day. Let's open up our scratch pad, and our example trade is going to be a bull put spread. And it starts with a bullish position. We're going to sell a 20th of June 255 put. That looks like that's trading between 365 and 380. Let's say we're able to sell that for 370. Then at the same time, we're going to buy, same month, same expiration, different strike price. We're going to buy the 250 put. And that looks like that might cost us between 262 and 268. Let's call it 265. It's just going to allow us to use some nice round numbers here. So as we do this, this creates a bullish put spread. Let's talk about why it's a bullish put spread, what it can make, what it can lose, and then we're going to plan for potentially making and potentially losing money on this trade. All right, but it really starts off conceptually as this bullish put. When we sell a put, we're accepting a payment from another trader conceptually. It's not like we have this intimate one-on-one relationship with another trader out there in the market, in the options trading universe, but just think about it that way. I think it's easier to think of it this way. Just imagine somebody's paying us $3.70 per share. On 100 shares, that's $370. So that's what we're collecting. But in exchange, we're giving a contractual promise to them. We're promising them, if they need to, they can sell shares. They can sell 100 shares of JP Morgan to us for $255 per share at any time between now and the 20th of June. So contractually, we now know we might have to buy shares at $255. Unfortunately, we don't know how much we can sell those shares for if we need to unload them. That, John says, is this the same thing as a short put, Vert, just a different name? Exactly right, John. Yep. It's kind of like you might refer to your car as a car, or it could be a sedan, or it could be a four-door, it could be, you have all sorts of different generic names to describe something. Yeah. A bull put spread is the same thing as a short meaning that we're selling to get into something, which is what we're doing here primarily. It's known as a vertical spread because the only distinction between these two contracts that we're entering into, notice they're both the same expiration, they're both the same stock, they're both puts. We don't have a call, we don't have a put, we're not splitting it up between different option types. The only distinction here is that one is $255 strike, and the other one's $250 strike. So if you can imagine, those are vertical. There's a vertical difference. 250 is lower than 255. Yeah. So there we go. Yep. So it's also known as a short put vertical spread. Tatiana says, do we need to have the stock? Nope. Not a requirement here, Tatiana, because really the trader's objective here very likely is to not ever even deal with shares of the stock. Even though we're entering into contracts that involve the potential for exchange of shares of stock, most likely the trader's objective is to get in and get out, no shares ever traded. Okay? But in this case, we have one contract for which we were paid that carries with it an obligation to maybe have to buy shares at $255. That's up to the other trader's discretion. Now we're also at the same time in a second contract, and this one's purpose is to provide an outlet if it becomes necessary. If we get stuck with shares at $255, we're not just left there in the wilderness wondering how much we can sell those shares for. We now have the contractual right to sell those same shares if we need to for 250 bucks. It limits the downside risk of the trade. If we didn't do this, and this came at an expense, to limit that risk to just $5, it came at an expense. We had to spend $2.65-ish. Depends on how much we actually trade this for. If our order fills, how much do we fill it for? But yeah, there's a little cost here. But if we didn't do this, all we would know is, hey, we got paid 370 bucks, and we might be stuck with shares at 255. And if we have to just sell them at market price, if the shares are collapsing in value, maybe we sell for 245, maybe we sell for 230, maybe we sell for 200, maybe we sell for 150. There's a huge risk with selling what's called an uncovered put position, or an uncovered short put position. All right, so that is our bullish put spread. Why is it bullish? We know why it's called a put spread, because there's a spread between the two prices we're dealing with, $5 spread, and it's constructed using puts. That's pretty self-evident. Why is it bullish? Well, because the trader's preference here is for the stock to stay above our spread, above $255. Why do I say 255? Because if we're above 255, we're also above 250 by default. Don't need to say that. Yeah, but we just want to stay above the spread. What we're really hoping for is that these contracts just expire worthless. Okay, let's map this out on our chart. I'm going to draw in a couple of lines here. We now see this was the technical logic for our trade. Let me remove this. And I'm going to draw in a couple of lines. One right at 255, just below today's candle. Let's put that right here at 255. Carry it out here. So that represents the one contract. And the other one's going to be down here at 250. I'll get as close to 250 as I can. And let's carry that out to here. I'm going to make it nice and level. There we go. So those represent our two contracts. You can see we're already above those contracts. All right. Now, let's see. What did it say? Oh, yeah. Frank says you need the stock to go up. Actually, we don't need it to. We probably prefer that it does. Notice, where is the stock right now? And what if it just went sideways right from here? It's already up there at 262, almost 263. If it just went sideways and we wound up at 263 on June 20th, if someone has the right to sell shares for us, they paid for that right. They have the contractual right to sell shares to us for 255 bucks. So what? It is not to their advantage to execute or to assign that right at that point. They'd be underpricing the market by nearly $8. Yeah, go ahead, sell me the $263 stock for 255 bucks. Twist my arm, right? That's the way that our hypothetical spread trader might be thinking. But yeah, this trader is likely to say, Cameron, you know what? I have the right to sell shares to you for 255. I'm not going to do it. Keep my 370. Now, at the same moment, at expiration, we have the right to sell shares to someone else if we want to for 250. Those shares are worth 263. Why would we want to sell shares down here at 250 bucks? Probably don't, right? So this contract expires worthless, and we keep the 370. This contract expires worthless, and we lose the 265, but that realizes for us our maximum gain on this trade. Our maximum gain is our 370 collected minus the 265 spent. That leaves us with $1.05, or $105. Now, that doesn't sound like a lot, but we're also not tying up a lot in this trade, comparatively speaking. You know, if we were to go buy 100 shares of JP Morgan, that would be a $26,000 trade. This is not a $26,000 trade. How much is the cost or the maximum loss? And I'm going to throw in one key phrase here to both of these. That's an abbreviation for theoretical. Our theoretical maximum gain and our theoretical maximum loss. The real reason why we call that theoretical, because things can change if we get assigned. Things can change if we get in there and we start tinkering with the trade. Let me sell this one. Let me buy that one back. That kind of stuff can change these outcomes. But how much is the most we could lose on this trade? Well, let's suppose the stock misbehaves and collapses in price. This is called a bullish strategy. We'd like it to be, if it stays where it is, great. We make our maximum gain. If it drops down but stays above our spread at expiration, great, we make our maximum gain. Now, there can be some rare, comparatively unusual exceptions to that, but out-of-the-money options almost certainly just expire worthless, okay? And if the stock were to go up, we'd feel even more comfortable that was going to be the case. But if our stock falls, let's say it comes down here to 240 or 245, just below our spread at expiration, let's talk ourselves through what's likely to happen at that point. Well, someone has the right to sell shares to us for 255. Those shares are only worth 240. They can't get 255 anywhere else, so they sell it to us for 255. And we think, our shares are only worth 240. Now I'm stuck with them. Oh, no, I'm not. I can sell those for 250 according to the terms of our long contract. So if we get stuck with the shares at 255 and we sell them for 250, that's a $5 loss. But we did collect a 105 credit. That was what we're trying to make out of this trade. Didn't work out, but that can partially compensate us for the loss. And that leaves us with, overall, a $3.95 risk on this trade. Yes, in this trade, the way it's constructed for this example, there's basically $1 that can be made and basically $4 that can be lost. It is a 4-to-1 risk to reward ratio. That's the way it works when we have higher probability scenarios like this. This stock doesn't have to lift a finger in order to have our maximum gain. It can drift sideways, it can drift upward, it can even drift downward. As long as it doesn't go down too far, we're in good shape to make our 105. It's really just if the stock falls and continues to fall, and especially if we get to expiration, we're below 250, that's where we could lose the maximum loss here. So that's the scenario for our trader. This trade, and this is the trade we're going to do, it may work out. It's most likely going to work out, but it might not. So let's plan for both of those scenarios. All right, so here's a plan that might be typical. Number one is if we can make $1.05, it might take us as long as 38 days to do that. But in plenty of cases, not every case, but it's not entirely unusual either, maybe we can make a good portion of that in a significant amount less time than 38 days. So let's talk about managing the fun part of the trade, the managing profits. Some of you I know, a lot of you have been following me for months or years or more than a decade in some cases. So I know that some of you out there have probably been either on paper or in real money, have been in a vertical spread, in a credit spread, and you thought, hey, over the course of the next 38 days, I could make $1.05. And you get to day 5 or day 7, and you've already made 80 cents. It's an unrealized gain, but you've made most of the profit. Well, what might a trader do? Wait around the other 30 days or whatever? Maybe hopefully make the other 20 cents, or maybe even lose the 80-cent unrealized gain? Now, what some might do is employ a rule. If I can exit, maybe I'm not going to shoot for the full amount that I could possibly make, but if I could get out sometime before expiration with most of that profit, let's do that. Yeah, Greg says close and take that profit. That's what some traders will do. So let's employ maybe an 80% rule. If at any time, whether as we're starting our journey from day 1 to day 38, if we get out at any time where we're capturing at least 80% of this original gain, let's make a plan for that. So I'll tell you, that's going to come out to we want to make at least about 80 cents. It's going to be a little bit more than that, about 84 cents. But just to be specific, what's 80% of 105? Let's multiply that by 0.8, 84 cents. So if we want to capture an 84-cent profit where we were paid $1.05 to get in, how much is the most we can spend to get out? How much is the most we can spend? 21 cents. So let's make a note here. Out at 21 cents. So if we've collected 105 and we only have to spend 21 cents to bring this trade to its conclusion, that would then realize for us, setting commissions aside, 84 cents profit. That's 80% of our 105. Now, that's the fun part. Let's also make a plan for if this trade is misbehaving. How many of you looked at this and you thought, I'd really prefer not to lose 395 if we can avoid it? Well, maybe it can be avoided. It's not entirely in our control, even if we employ this strategy that I'm about to talk through. But let's say that our trader collects that 105, and what they're hoping for is for the value of that vertical spread to go down towards zero. That's how credit traders realize their profits. But instead of it moving down towards zero, it starts to march upward. Now, we got paid 105 to get into this. Theoretically, what's the maximum value where the bleeding finally stops on this trade? 105 that we got paid to get in. If we have to spend more to get out, really $5 is about the most we should have to spend to get out of this trade. So what some traders might do is they'll say, well, I'll take the 105 credit, but if this starts to march toward $5, I'm going to get out before it gets there. And it might be if we have to spend, let's say, twice as much, maybe it's even 3 times as much. Let's do that for this example. 3 times as much of 105 is going to be $3.15. So let's put this in as our plan for managing the downside. This can be our stop order. Now, whether you're using this specific strategy or not, that doesn't really matter to me. What does matter is if a trader has a concept of when they want to get out of a trade, I want them to be able to at least place the order correctly. All right. So I talk through and I'll throw out some example numbers. The numbers are just to set the stage for actually putting that plan into practice. Okay. So let's say that we're going to get out at 315. We don't want to get out at 315. We're hoping we don't have to. But if we do, what that would do is instead of suffering a $3.95 loss, if we're able to get out at 315, having gotten in at 105, that would be a $2.10 loss. It's about half as much as we have total at risk. If we were to just put this on, if it started to misbehave and we suffered the maximum theoretical loss. So those are going to be our plans. This is going to be our plan to manage reward. This is going to be our plan to manage risk. So let's do that. Let's put all of this into practice. And I'm going to do that I'm going to come up here where it says spread single and change that to vertical. Now what that does, right now when we're set on spread single, it just means show all the individual strike prices for options. If I change this to vertical, it pairs them all up. So then we can go look for the vertical that we were interested in trading, which is the 255 and the 250. We're going to go to the puts over here, and we're going to click on the bid price to start to construct our trade. So if I click on that bid price, there's the beginnings of our trade. Let me hide this left column for just a moment. Now in my paper money account, this is going to default to one contract. Typically, it's because I changed my preferences. Typically, this would go to, by standard default would be 10 contracts. Okay, so we always just want to make sure that we're putting in the correct amount of contracts for our trader. Now, in this webcast series, we try to limit our risk to about $4,000 per trade. This trade, if it went completely haywire, what's our maximum theoretical loss? Even with a planned exit trying to manage the risk in place, we still have that maximum theoretical loss of $3.95. I'm still going to plan around that sort of worst case scenario. So one contract exposes us to $395 risk. We're going to try to cut that to $210. Still position sizing though for the worst case outcome, which is our 395. So one contract, $395 of risk, 10 contracts, $3,950 of risk. So let's just crank this on up to 10. Now, this is to get us into our trade. And how about we say we're willing to accept that 105 credit that we've been talking about? We'll set that as our limit order. That just means that's the lowest price that we would accept to get into this trade. But now, and I'm going to switch this back to a default. This is what you would typically see on your paper money if you're following along. Down here where it says advanced order, the system is ready now for us to place one order to get in. Well, I want to get in, but also have our two orders to get us out of the trade. So I'm going to change this from a single order to, and this was the request that came in earlier, an OCO order. I'm going to switch this to the first triggers OCO. What this means is our first order, the order to get into this vertical spread, if it fills, then triggers two other orders to go into a place. And only one of which we want to actually have filled. You know, maybe we can make our profit and we exit, or we encounter a loss and we exit there. But we don't want to exit the vertical spread and then exit it again. So one of those orders is going to cancel the other one. So let's choose first triggers OCO. All right. So with that selected, the system is now prepared. Hey, Cameron's about to enter two other orders. So let's place those orders. So to construct that, we're going to go back up to the original order, right-click on it, and create an opposite order. This is an order to get out. Let's do it again. Right-click, create an opposite order. That's another order to get out. One of these is an order to get out with our profits. The other is going to be our order to get out with our losses. So let's do the fun part first. If we're in for 105, we know that we'd prefer, and actually let's change both of these exit orders to good till canceled so they don't just expire on us at the end of the day. We'd like to be able to get out for 21 cents if possible. So this is our plan to manage our profits if profits manifest themselves. Our plan to manage our losses is, hey, let's stop the bleeding. We're going to enter a stop order. And we prefer to sell that or to stop the bleeding if we've got to pay $3.15 per share. Let's not go all the way to 5. Let's just get out then. So those are our two orders to manage profit and to hopefully manage loss. A couple of things that we want to bear in mind. This limit order is sort of an absolute. This order will not fill for more than 21 cents. If we're able to get out at any time between now and expiration, 38 days from today, that's the most we would have to pay to get out. Otherwise, that order just doesn't fill. This order is not an absolute. This is actually a trigger price. This is our stop order. What we're saying here is, hey, if the price happens to rise to 315, we were hoping it was going to go down. If it starts to go up and we're having to spend more and more money to get out of this, get me out if that price ever rises to 315, and that triggers an order to get out, but it may fill for more than that. So Tatiana says, can we unlock this? We can, but it doesn't serve our purposes when we have a specific number in mind on either side, Tatiana. If I unlock, for example, this limit order, notice it changes. It just means, hey, just go with whatever the market is right now. I don't want to go with whatever the market is. Let's change that back and lock it in. That's the limit we want. And we want our stop at 315. All right. So here we are putting our plan right into place. Now, this is probably going to cover the trade. It's not guaranteed that it's going to cover the trade. You might think, well, hey, Cameron, isn't this just going to get us out if we're profitable or get us out if we're losing money? Possibly. But what if the value hovers between 21 and 315? We could still hit expiration in between. And we want to be aware it's still going to require some manual maintenance. We're still going to have to keep an eye on things. But yeah, if there's ever a chance in the next 38 days to get out inexpensively for 21 cents or less, this order is there to help us do that. If there's ever the unfortunate circumstance where we have to spend, and this would be before we get down to 21 cents, if we have to pay as much as $3.15, that would trigger that. Okay, so let's click confirm and send. And we're going to sell 10 of these 255, 250 put spreads. We're trying to get at least $1.05. That's what we've expressed as our limit. We've then put it in order to buy for 21 cents as our limit, or buy for $3.15 as our stop. Now with this stop order, there's a reminder down here. It says, due to potentially wide markets or liquidity risks at the time of activation, we don't know how liquid this option or these options are going to be if and when the stop order is triggered. This order may be manually substituted with a limit order upon activation and worked until filled. That's just the system trying to get the trader the best fill it can. But a stop order in any case is never a guarantee that that's exactly what the exit will be if that order is triggered. Orion says, how do I close orders? And is it important to do it at the same time? Orion, I'll show you. I'm not actually going to close the order, but let's go ahead and send this order off. Let's click send and see if we can get this filled. And yep, there we go. Sold for 109. Okay, so we got a little bit better credit than we expected. But yeah, those orders are now waiting here. And we find that on our monitor page. If we want to go see the working orders, down here's the position. Right up here are those two orders. They're linked together because one of those will cancel the other one if it gets filled. But if we wanted to cancel these, we can just right click on it and cancel. We can cancel the order or we can cancel the whole group. Okay, I'm not going to do that, but that's how we could do it. Lisa says, is there a way to better ensure that we get our something where we want? Does a stop limit order do that? Our fill order, Lisa? Yeah, good question. Better is always, that's a strong term. There are different ways to enter orders. I'm not going to go into them in too much detail, but a stop limit order is sometimes employed when a trader, let's say we want to get out for $3.15, but we don't want to spend more than $3.50, for example. That could be entered as a stop at $3.15 with an attached limit at $3.50, but there's a risk in doing that. Because if those contracts, let's say we have a really bad down day, big gap down overnight, and all of a sudden our spread goes from trading for $1.05 to trading for $4, it's possible it might gap right on down past our orders. We said, stop me out at $3.15, but not if I have to spend more than $3.50. Well, now you'd have to spend $4. That order wouldn't fill. And we could go right on down to $5 to our maximum theoretical loss, and the order just didn't do us much good at all. So is it better? In the case of a stock that's falling kind of fast, maybe. In the case of a stock that moves really fast, maybe not. So as always, when we're making trading decisions, we try to make the best decisions that we can, but ultimately the market does what the market's going to do, and that tells us whether that was a better idea or not. Generally, we only know that with the benefit of hindsight. All right, so guys, we've actually accomplished what I set out to do today. I wanted to talk through the management of these credit spreads for trades that are going well and trades that are going poorly. We're in for $1.09. We're trying to get out for 21 cents. That would be the best outcome here that we're shooting for. We also may have to pay $3.15, possibly more, to get out if our stop is triggered. But we do want to know that if the stock, let's say it goes down, but we never quite hit our limit, we never quite hit our stop, this is a short put spread. If we get down below that short strike and we finish in between our strikes, it's possible. This trader could be assigned the shares at 255 and their 250 long option just expires out of the money. and now they wind up buying, 100 shares, or in this case, 1,000 shares that they weren't really intending to trade. So is this sort of a set it and forget it and ignore it until expiration? No. It can be quite useful, but if our stock starts to fall, especially if we're getting down here closer to expiration, if we slip down below 255, that assignment risk on that short can be elevated. It's always present. Being assigned on a short option can happen at any time. It's just comparatively unlikely to while it's out of the money. If it goes in the money, especially if we're still above that long option, that's a risk we need to keep in mind. Tony says, show how to close out again. So Tony, if you need to review anything that we've discussed, so we placed in a couple of exit orders here. This is one of those webcasts that's scheduled to be added to our YouTube playlist. So everybody, if you haven't done this already, make sure that you've subscribed to our YouTube channel. The channel name is Trader Talks Schwab Coaching Webcast, but the way to subscribe to that is just go down below the live stream right now, click on the subscribe button, but then you can just go to YouTube, look for our channel, and you can find our playlist right here on our homepage. You can also join the live streams here, but if you wanted to see previous webcasts in this series or other series, you'll find them right here. Like this webcast series, if I scroll down a bit, it's going to be a little bit further down. I believe it was Michael Fairborn that filled in for me last week. Let's see, where is it? No, it was Barb. There she is. But you can find that playlist right there. Oh, actually, it wasn't Barb. Nope, it was Kevin. Got to give credit where credit is due. Kevin did it, and he talked about put options. Anyway. All right, Tony, very good. Everybody, but it's time for me to let you go. We've covered the territory that we wanted to cover today. We planned, placed, and executed an example trade, including a plan for managing profits and a plan for managing losses. This is the sort of thing that we do in this webcast series. I hope you all enjoyed it. We'll do it again next Tuesday. But another thing to remember is that we have other ways to connect with your favorite presenters in between these live streams. If you have an account on X, give us a follow on X. It really is the best place to connect with your favorite presenters. You should be following them there. You can follow Connie on X at Connie Hill CS. You can find me on X at Cameron May CS. Let me just show you that, because you do want to be precise with these handles. There are lots of very similar handles. So just make sure that you know who you're dealing with. At Cameron May CS is that handle. But it's the best place to see more current information about the markets when we don't have the luxury of talking with you directly during a webcast. So connect with us here. Thanks, Connie, for helping out in chats. I don't believe I saw a survey. No, there wasn't a survey. Connie would have reposted that a couple of times. Thanks, though, Connie. But I do want to thank everybody who has already clicked the like button, the thumbs up. That's very much appreciated. 162 people watching, 47 have already clicked the thumbs up. That sounds like applause to your presenter. It also gives a boost to my video in the YouTube algorithm when you do that. It only takes a second, these things. Just click on that like button if you've enjoyed a webcast. It's always appreciated. It definitely helps. All right, everybody. I will see you in a future webcast. I'll also look for an X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.